Yesterday, guys, I talked about a master portfolio I was getting into, and I actually already own all these funds, and I decided to drop UTF, which was a utility fund, and that's how I was trying to sell it off. I couldn't even get market price for the damn thing. Um, it's got a lot of or yeah, I think it's pretty big fun, but it's a closed-end fund, and they're hard to trade, so I couldn't even get a sell at market, and it made me decide to get out of it. And plus, the yield's a lot lower than some of the majority of these funds. Like ASGI is a similar type of fund. It's an infrastructure fund, but on a global basis. Still a closed-end fund, but the yield is like currently around 11%. So I decided to replace UTF with ASGI. It's had a stellar year. I haven't bought into it yet. I haven't got a discount on it as of yet, but all the rest of this I currently hold, and I was wondering, should I be even thinking about selling some of these positions, and I decided not to. They seem to be more liquid, to be perfectly honest, and amongst these you got what, one, two, three, four different NEOS funds, which I love, and they cover both the indexes, and then you got the energy one with MLPI and real estate IYRI, kind of like an infrastructure thing actually. And I kept the BDCs because I like willing them. So I changed up again. I decided that I have these holdings. I have QDevo in there, and I have TDEC and TSPY, which I'm kind of hesitant to put a lot of money toward those two, to be honest, because if we look on the day how much they fell relative to, like, if you look at TDAC and compare it to QQQI, almost step in step with that one, lockstep with that one as far as the decline. Let's look at T-SPY, though, and compare it to SPY-I, and it significantly fell much lower than what SPY-I did. So I'm kind of hesitant to go too hard with the T-SPY, TDAC positions right away anyway. But SPY-I and QQQI, I'm already fully allocated for QQQI, so I'm probably going to lean more toward buying more shares of SPY-I and probably QDevo over time, and fill out my positions on MLPI, IYRI, and the rest of these funds on the breakdown. So we look at the breakdown. Let's go to how I'm going to do this for each group. So group one's my income anchor, kind of a mix of collateralized loan obligations held in two exchange traded funds, JAAA, which is AAA rated, and JBBB, which are like B plus or whatever. That's where I'm going to hold half my income from on this dividend portfolio, right in there. And that's current monthly income that would be generated from that. Of course, if Fed fund rate comes down, this is going to change. So keep that in mind. And these are the tickers in group two. Well, I'm going to allocate, not exactly, it's not going to be allocated exactly evenly at 8,800 in each fund. I've already got more than that in QQQI, and I'm almost totally allocated to that too. And excuse me, guys, totally allocated that in SPY. I just need another, probably not even 100 shares, and that would allocate me fully in that. And QDevo I had just started. THQ, same thing. And so I got to fill out the other positions first, and that's probably what I'm going to do. And you can see the subtotal on the yield is over 10% on these. That's group two. That's the high yield engine. Now I'm still keeping quarterly paying BDCs because I'm doing kind of a will strategy on them. I currently got options. Well, actually, ARCC, I bought shares, had a cover call that got taken away. I'm probably going to sell a put at the money pretty soon on that. OBDC, I have 100 shares. I got a cover call on HTGC, same difference. I got 200 shares of that one. But you can see I could allocate 4,000 each to each position, so I'm going to mix that up. It just depends how they behave. And I might even add Trend later on, Trinity Capital, in this mix for my will strategy quarterly payers. And so here's the breakdown of how they pay. My monthly payers in Group 1, they all pay monthly. Group 2, all of them pay monthly except for ADX. My quarterly payers are the BDCs and ADX. ADX pays a really small distribution. And the way I'm going to handle ADX, because the way it pays out, right, I like its performance over time. It's a closed-end fund, but it's beaten the S&P 500. If you compare it to SPY, it's beat it over the last 10 years. It's been a stellar fund, been around a long time, so I kind of wanted it in the mix. Kind of almost like a growth engine. I decided to load up on it during pullbacks, corrections. That's going to be my go-to as a growth engine, and all the rest is going to be my income, basically. So this is how they performed today, and I discussed that earlier while I was hesitant for T-SPY and TDAC. I think they get hurt more during pullbacks and corrections. Sorry for the background bird noise. They're feeding today. So that's pretty much what I'm going to do now. Because I couldn't sell out of some stuff, and well, actually, I had positions in all these, and I'm up on them. I'm up on all these positions, and I don't want to sell them. They've been stellar for me, and I'm like, I'm not selling out of these just to rotate and stuff like UTF or some of the closed-end funds I had previously selected. I still want an infrastructure fund, so I threw an ASGI in there because it's done really well and the yield's really decent on that. I'm not even sure that pays monthly. According to what I found out, it does, but we'll have to look that one up. I know ADX is weird because it only pays like really small quarterly payments, and the yield on it is like between 6 and 8%. So they allow some uptick in share price too. In addition to the fact they're trying to target a 6 to 8% analyzed distribution with smaller payments on a quarterly basis, and a bigger, larger payment in December end of the year. I like ADX. I'm going to keep that. I keep on harping about that. And I like the BDCs. I like Group 1 for more stability and rotation. Like if they go down during a correction, JBB, I think during 2020 only fell like 6%. JAA was even less than that. So if you think about a 20% haircut in the market, and I have a lot of NASDAQ exposure, obviously, and even the S&P 500 leaning toward tech exposure now. So a 20% would be a minimum pullback for me, or correction for me to want to completely rotate out of JAA and JBB into these other Group 2 funds. And that Group 2 fund family that you look at, that's my high yield engine. So that's where I plan to rotate at some point, probably leaning more toward the NEOS funds. They've grown exponentially. They perform really well. A lot of what you get in the form of distributions is for tax purposes filed as return on capital. So that's great because you get a discount on a certain basis of that, right? And that's gonna where I'm gonna be leaning. I'm already fully allocated on beyond 8,800 for QQQI, and I'm close on SPY-I. So I might change this up again and just make those my two core funds and drop out of THQ and T-SPY and not THQ, but T-SPY and TDAC potentially. If you look at the estimated yields on these, though, that's incorrect. So don't trust everything you see online, or I used AI to complete this thing, and it's showing this yield that's way subdued for T-SPY and TDAC. So that's actually going to be different. And the MLPI has got it at 6.5%, and they're targeting a far higher yield than that. So it's like a conservative estimate of where my yields would be. QQQI looks a little high, though. But, I feel kind of comfortable with this for the most part. I'm not going to be 100% allocated anyway. I'm not even 50% allocated yet to this portfolio, and we're pulling back currently. So I feel like, I could target this during the next pullback. It could be a single-digit pullback, less than 10%. I'm going to start allocating pretty much close to what it says there, 8,800, because I'm already fully allocated plus some for QQQI. So my balances are going to reflect different than what the equal breakdown of 8,800 in each of these funds. I'm going to have a different allocation over time on this, probably, more than likely. So anyway, that's what I'm looking at. I got the infrastructure fund in there with ASGI. I've got THQ as a healthcare fund. IYR is kind of a real estate / infrastructure. It's got different stuff in there. And then you got ADX, which I consider almost like a growth fund because it's targeting overall performance and return, and it's done really well. If you look at ADX, it's done really well in its history. Been around for decades. Been around like almost 100 years. I think it originally came out in 1929, and it's outperformed the S&P 500 in the last 10 years. We could check that. Let's check that. Let's see what it's done. Okay. Bear with me. So ADX. And we want to select, we'll have to select SPY, I think. Hit that. Keeps on bringing up JEPQ. So if it does that, so I had JEPQ selected at one point. You just start it over again. Now ADX is on there. Enter SPY. Add the comparison. This is on totalrealreturns.com. If you want to check total returns since inception, you could even change the dates on it, see what it's done over time. But you can see what we've done year to date. We're flat, we're below SPY. But if you look at that, ADX is in red, SPY is in purple. Yeah, you see, man, I may stand corrected here. Look at that chart, though. It looks like SPY is outpacing it, but it's similar trajectory pretty much. You get the exponential overall returns. It's going by the inception date of SPY. But if we look at some of the dates there going back over time, 2025 ADX beat SPY readily. 26% return. This is total returns, by the way. 2024, it beat SPY. 2023, it beat SPY. 2022, slightly more of a sell-off. That's during the interest rate, Fed fund rate going up, inflation, battle. 2021, it well underperformed during that time period. So 2020, slightly underperformed. 2019. Anyway, you see the track record. Overall, it's done really decently. So, I mean, I could just outright buy SPY, but I like income too. So this will give you some amount of income also and performance on a certain level. So that's why I'm going with ADX, I think. I could mix it up too. I'd buy shares of stuff individually, like dollar cost average, Apple and Amazon, which I'm buying currently. And I even got a share of Netflix. And I could always just add some growth in there, straight out growth with SPY or one of the NASDAQ ETFs too. So I have a mix. I have a two investment strategy, I have an income strategy, and I have a growth strategy. But primarily what I talk about on my channel is just dividends. So that's why I'm covering ADX today and why I'm talking about allocating money to it. All right, guys, this ain't financial advice. Take it with a grain of salt. Just what I'm thinking of doing. I'm already allocated pretty heavily in those funds I just showed, and as a result, I'm probably going to stick with them now because the closed-end funds are harder to trade. It seems like even if they have a lot of assets under management, the liquidity on closed-end funds it's difficult to get fills. I got two on here, two of the better performing ones with ADX and ASGI, and I'm probably just going to stick with those. In addition to my BDCs, which are pretty liquid and they have options, so that I have optionality on these BDCs where I could generate some option income in addition to getting the income off the quarterly payment plus my high yield engine for Group 2. Then I got my stability over here with the income anchor. All right, guys, take care. Bye.